Welcome to this episode of the Hidden Money Podcast. We are excited to have some cool and not so cool guests with us today. Our main topic is going to be the selling of a business and some important hidden nuggets and hidden money in doing that. But right now, I want to introduce our guests, Kyle Gabhart and Tyler Wright. They're from Bluegrass Legacy, our financial planners, our firm's financial planners. Kyle's the founding partner. Tyler, however, is the guy I go to whenever I have questions about financial planning. But thank you very much for joining. You're also an author, a great book, Legends Never Die. The one book of yours I've actually read. It's a good one, but tell us a little bit about yourselves, please.
Oh my gosh, appreciate the intro. It's been an absolute pleasure getting to know you personally and professionally over the years. Have a great working partnership. You guys are the real deal when it comes to tax planning. And awesome to be back on the podcast. You've upgraded things a little bit since I was on last, so
yeah.
Nicely done there. But yeah, so we do financial planning and wealth management, and similar to you, primarily our clients are business owners, entrepreneurs, and so we're constantly having conversations with them around what does the future hold for the business, and so we're thrilled to be talking about exit planning. But because people get really, really distracted by my good looks, I hired Tyler. He came on board about 3 years ago because we had to have something to balance it.
It's hit or miss some days. Really depends. But much like that, kind of what Mike hinted at, when we have financial questions, we're just in a habit of going to Kyle, like, Kyle, what's this? And then, hey, I've added Tyler to this. Hey, I've added Tyler. And so we've started working more and more. And so as a business owner,
Tyler actually answers the phone, and he usually has an answer.
You guys have gotten a lot better because it used to be exactly like you said. You reach out to Kyle, then Kyle's like, hey, Tyler, can you help them with this? Which, of course, hook, line, sinker every time. But you have done a really good job of reaching out to me and removing the middleman and the delay that could cause. But I'm sure you guys are business owners too. You understand the chain of command and how if you start at the top, it really slows things down.
Our clients are learning not to go straight to me and Kevin, because if they want a quick answer, they go to the person that actually is going to do the work more often than not.
and our team is trained just like, Tyler, you're a CFP, so you can answer everything that we need. You do a great job, and that is very typical of kind of a business structure, a self-employed owner. They're not focusing so much in the business, but on it, right? So is that kind of y'all's experience as well with working with business owners?
It is, and it's a great segue into the topic around exit planning, right? Because what happens far too often is you've got someone who's a really successful entrepreneur, and they're just killing it in building up this business and building up a bunch of raving fans around them. But then if they exit at that point, well, then everything that was connected to them falls apart. So they've got to find a way to duplicate. They've got to find a way to put in standard operating procedures. They've got to find a way to disentangle themselves from the operation. And that's so much a part of what exit planning is.
Yeah, especially in professional service firms. I've seen exits go bad because especially if it's a single entrepreneur, he owns the business, he's the main face of the business. Of course, he has a team. Once he leaves, the clients tend to leave if they don't have relationships with the people who are buying it or taking it over. So,
oh, no doubt. The thing that I often point out to folks is they think that what they have is a business to sell, when in point of fact, what they may actually have is a job to sell.
Mm-hmm.
And funny enough, as great a job as it might be, as lucrative as it might be, people aren't so interested in buying a job. And so you've got to structure things in such a way that it's a business that runs in spite of you, right? So we're all here. There's 2 business operations behind us right now while we're in this studio. If a client needs something, that all needs to be able to operate without us being the go-to for making it happen. You just got back from vacation, and you've got to be able to go do that and not be on your laptop at night in the hotel, checking email and so forth. Don't get me wrong. Early on, we were all at that stage, but you've got to get to the point that the business can function outside of your existence, or really you just have a job now.
as a client of Bluegrass Legacy, I can attest your business runs in spite of you.
And maybe even better. No.
Yeah, for sure. For sure.
I laughed too hard at that one.
I guess in your business, Kyle, you have a succession plan. So you're not just kind of blind working day to day. You have at least something on paper that you're like, "Here, this is my goal to eventually exit the business. Not exit work. That's where legends never retire. That's where that comes in. You're not going to ever retire from working, but you're going to retire from this quote unquote business at some point and transition into something else, unless you're just a freak and love to work till you're 80. But I guess you have i.e., this is where Tyler comes in,
Yeah,
right?
because there's two ways a business owner can exit. It's when they don't want to and they're not expecting to, or the beautiful roadmap that you've laid out. And to talk about the first one, it's the continuity plan. What happens if Kyle doesn't show up to work one day and tragedy strikes? And we built a plan for that where I've got life insurance on this guy right here. So if that does eventually happen one day, there is a playbook that we can run to make sure that the business is still going to be running smoothly, even in that event.
That brings up the importance of having good partners, because I could see Kyle being a little nervous knowing that you have life insurance on his life. And if you have a partner,
drink that.
He didn't pour my coffee. I poured this myself.
No, we actually do the same thing, and never once have I worried about you offering me for the life insurance policy. The wife, on the other hand,
Yeah.
I'm careful.
But yeah, so actually 55% of exits are unplanned. And that unplanned could be death, but it could also be disability. It could be an untimely divorce that you weren't expecting. It could be that you just have a disagreement with your partner. There's a variety of reasons that it could happen unexpectedly, but the beautiful roadmap is great. You've got to have the contingency plan in place and be prepared for what could go awry. So that's step one for sure.
So let's say I'm a business owner. I'm maybe 5-10 years in, I'm in my 40s or 50s. I eventually want to sell this business I've done. What do I do and how do I start today? Now that's a good step one. If something were tragically happen to me, a car wreck or who knows what's going to happen to the business at that point? But let's say, we do have great health, we wear our seatbelt and everything's good, but we eventually want to sell. How do we start structuring and planning today to get to our goal?
I love that question. I want to just back up for just a second to say that it's important to really frame that in terms of getting in front of that decision making and that roadmap long before you actually plan to exit. Far too often we've seen, and I would imagine you've seen as well, the scenario of someone just works themselves to their core and just nose to the grindstone. And then once they're exhausted,
Like, I'm done.
they go, okay, how do I get
Who
out of
wants
this
this?
thing? Anybody want to buy this? Yeah, absolutely.
Throw it over your shoulder.
Yeah.
Would
Yeah.
anyone give me money for that?
Uh-huh. And
And they sell for a much lower multiple than that happens.
they
A much
absolutely
lower.
do, right? Because of the mess that you're handing off to somebody. And that's the scenario of you got to run it all the way out. Never mind the 55% of situations where you exit long before you expected for some reason you hopefully weren't going to have to deal with. So it's crucial for this to be something that's thought of at the beginning. And I'll use ourselves as an illustration. I am on year 17, or year 3, I guess is the way to think of it. Year 3 of a 20-year roadmap. I've got 17 more to go in my exit. I have a 20-year exit plan. And I'm on year 3 of that 20-year exit. And Tyler's a piece of that 20-year exit plan. But there's a lot of other pieces that are part of that too. And it involves structuring the business in a certain way. It involves standard operating procedures. It involves putting the right seats in the bus in place. It involves putting things in a more automated fashion. It involves certainly the continuity plan. And I sell off chunks over time as a part of this long roadmap for exit, as opposed to I just got to grind and then hopefully someone will want to buy what I've built.
Yeah. And I want to throw in one other point, I think. A lot of us, I think most entrepreneurs that build their own businesses in the firm like we've built, we love our firm. We care greatly about our firm. And one day we're not going to be able to work. One day we are going to want to retire. But we don't want the firm that we've built to turn to something that we did not want it to become. So I think that also your plan and what you're going to talk about, that's an important aspect of continuing your legacy of the firm that you have built and created for yourself.
Well said. Well said. So let's come back to your original question. So frame it up again for me, if you would.
Yeah, the standard typical business owner, they may have a partner or two, maybe just a sole practitioner or sole proprietor. They eventually know, hey, I want to build this book of business and sell at a multiple of EBITDA or maybe a multiple of revenue, but this is my retirement. I'm not dumping as much money into retirement planning like 401ks or IRAs as much. It's like every dollar I'm making is going into the business. I need to scale. I need employees. I need marketing. I need all this. I don't have money to set aside for me. My retirement is what I'm building. And I need to get as much from that sale as possible because that's what I'm relying on. Now, I do think you do need to be smartly planning and investing along the way. But a lot of, I find myself in that trap whenever whenever you're starting a business, revenues may be down. You don't have the capital to even contribute to your 401k. So you really are banking on that future. So if someone's in that boat, how do you even begin the conversation of them thinking 20 years in the future? Because they're just thinking about tomorrow. And how do I structure everything to get that max?
It's a great question. Y'all are numbers guys, or at least you are. And what I would say is that it's a matter of a mindset shift where business owners typically focus on what income is the business generating. And the income's crucial. But the important mindset shift is to think about what is the business worth? What is the value of the enterprise I'm building? And thinking about that from the perspective of another buyer, not just from their own personal perspective of the blood, sweat, and tears and sacrifices they poured into it, which it's easy to attach value to that. And funny enough, a buyer doesn't care.
That's true. Most people only think about it as in I'm working in the business or I'm working on the business, but you need to work on the business from the perspective of the buyer. What do they care about? What do they want to see instead of just sitting in the owner's seat? There's going to be certain things you'll work on to make that an easier life for you, but building it for a buyer looks very different.
Absolutely. And if you're just starting to think about that a year or two before you're going to sell your business, you're too late.
You're changing all your SOP. You're changing everything, how your business functions.
Which is going to
just
disrupt
to get
the
it.
business.
Yes. You're like, oh, we got to automate. The buyer wants automation. We do everything manually. And you're scrambling and just
upsetting staff, which
client.
is the lifeblood of the business. You need to make sure retention is going to, retain. You want employees in a business.
Yeah. Yeah. So you got to season these processes. You've got to season the value that you're building in your business before you can exit it, right?
Yep, absolutely right.
Yeah. Iteration one of any automation, like we go through, like right now we're developing new products and it is a week by week change. Like that didn't work. We're constantly workshopping processes, internal stuff. So if you're revamping this in 1 year, more than likely it's going to be a broken product. And you're like, look at this. Who wants this? Nobody. So what are your steps of if a business owner was going to actually meet with you guys and sit down and be like, hey, I want to get the most out of my business. What does a typical process look like on y'all's end?
Yeah, I appreciate the question. So it starts by just getting a realistic understanding of what is the business worth, and to Tyler's point, how a buyer would see the business from the outside looking in, right? What is it that they're acquiring? Are there, to your point, systems and processes they're acquiring? Are there team members they're acquiring? Is there an engine for business development that's being acquired? Or is it just all of your contacts? Is it your Rolodex of relationships you've built up over time? Well, that's a problem because as soon as you walk out the door, so do all those relationships, right? And so it's a clear understanding of what is actually sellable, what is transferable to another entity. So that's step one, is getting that clear understanding. Step two is realizing that the value of the enterprise you've built is not a static thing that's universally true, right? If you just were to grab a group of business owners and ask them, what do businesses sell for? And you average their answers, they'd go, about 3x. And you go, well, okay, but why? Where did you get that number from? Well, that's what my buddy got when he sold his business, or
it's what I need to retire.
Yeah, that's the other one. Here's the number. I reverse engineered it.
Yeah.
That's what I need. Yeah, right? All kinds of reasons that people come up with it, but the reality, of course, is it depends on what industry you're in. It depends on how mature this business is. If the financials are a hot mess, then that's going to dramatically lower the multiple. Within any industry, there's going to be a range of multiples. And if you're average, maybe it's a 3. But if you're below average, it might be a 1.8. And if you're best in class, it could be a 4.7. And so suddenly, what you actually could potentially receive changes dramatically. So getting clarity on that, and then understanding, well, if that's where I'm at, if I'm currently at a 2.4 or in this range, and I could be up in the 4-something range, gosh, what would be the steps I would need to take to bring the maturity of the business up?
So y'all are actually doing research of, let's say, being a CPA. I'm like, hey, we have this awesome tax planning practice. What are the average multiples in the country, and what, because the revenue kind of dictates the multiple too. If you're selling a 10 million, 20 million, or a $1 million, that would affect it too. So how do y'all kind of dig into that data and find it?
Yeah, no, it's a great question. So that we really just take everything and throw it in ChatGPT, and whatever it says, that's what we do.
Cross-reference with Grok.
Right.
Yeah.
You got to make sure the info's accurate.
Do your due diligence, you know.
Yeah, so we have a couple of different data sets that we dig into, and it's kind of similar to what you would see from a real estate standpoint. Like there's comps, like what have similar businesses sold for recently, but then there's also historical data. So it's a combination of historically what is true in this industry, but also right now, where is this trending in your neighborhood? And your neighborhood is HVAC, right? Or your neighborhood is a professional services firm, maybe an accounting firm. And so depending on that, then we reach an understanding of what we're looking at. And it's a range, right? A business, like any other asset, is only worth what someone else is willing to pay for. And so we're helping people get an honest understanding of the range of value, but we're not able to actually directly assign your business is worth exactly $14.7 million.
So let's say someone's watching this right now and they're only 5 or 10 years into their business and they're loving it. They're thinking, most likely, because that's where I was 10 years into my business, I don't need to worry about this right now. When honestly is the right time to start thinking about your future exit strategy?
Yeah, I love the question. And I'm going to say that thinking about it as soon as possible is ideal. But to your point, there's some initial growing pains you've got to get past. But when you consider the 55% of unplanned exits, you owe it to your clients and customers to actually put a plan in place from a contingency standpoint, number one. And then number two, what proper exit planning does is build a better business for you, right? So over the next 15 years, do you want to just continue running really, really hard and fast and hustling? Or do you want to build a business that is running so smoothly like clockwork that another business owner is throwing money at you to take it away from you? That's the business you want to operate in anyway.
And then you might not want to sell. And I can speak to that myself. When I was doing everything at the firm before Kevin joined the firm as a partner, I did not love 90% of my job. And then when Kevin came, I got to focus more on the stuff I enjoyed doing, which actually happened to grow our profits, grow our margins. And then as we started building a better management team, I was doing 80% of what I loved doing. Kevin was doing 80% of what he loved doing. Margins started growing, profits were growing, revenue was growing. And you don't want to sell the business as much when you love doing what you're doing. But I mean,
but the
all
funny
goes
thing
together.
is, in that scenario where you don't want to sell it as likely, people are willing to offer more for it because of the thing you've built is that appealing.
We've
You're
noticed
getting
that.
chased. You know, you're not chasing people to buy. You're like, please buy.
Right.
Instead, you're like, I don't. It's almost this game where it feels like it's almost this game where like they're not willing to sell, but they'll hear you out, and then that's not quite what. Oh, here's more.
We
or
started
maybe
seeing some of these emails. You're like, we're not selling, guys. We love this business, but if we throw in a little bit more, average multiples are this, but we'll go there. You're like,
Right.
just leave me alone. But it is a nice place to be at.
Yeah.
So I think about real estate from the standpoint of, you've lived in a house for a long time, and when you're ready to sell it, you suddenly run around and fix all the things that have been busted. You get everything spruced up, you declutter, it's beautiful, and you're like, man, I could have been living in this
This
whole time, but I waited until it was time to sell it to get it cleaned up for somebody else to enjoy.
Yep. That's a very good analogy. Very good analogy.
Yeah, so just clean up the house you live in.
There
And
we
then
go.
you'll really enjoy it.
Absolutely.
Your employees will love it. Your clients will love it. You'll love it. Yeah.
On that timing question I asked you, I want to throw in a tax side to it because Kevin and I would say, man, if you are ever going to sell your business, the sooner you start planning for it, the more of that sales price you'll get to keep, thanks to Uncle Sam. There's so many different ways to structure on the tax side the sale of a business. There's some ways to structure it where you can sell it completely tax-free, but that takes a heck of a lot of planning. So don't wait. Don't wait until you know you want to sell it. Start talking to an advisor about how to season your business. Start talking to a tax advisor to figure out how to multiply the potential take-home pay so that you can go do your next thing. And as Kyle's book would say, go start your next venture.
Exactly. Yeah, the last thing you want to do is earn this extremely high multiple on your business and then give a giant chunk to the
Half of
government.
it to the government. I mean, I know Obama says he didn't build that, but we built that. Keep your money. Don't give it to the government. Not all of it.
Yeah, they're technically, like, think about it as a partnership. Like, if y'all are in a partnership, a 50-50 partnership, you're splitting profits 50-50. Well, the government's this silent partner in everyone's business that they're like, hey, I want 37% of everything you make.
I wish they were silent.
I'm like, what? Yeah, true.
Is there a mute button?
Yeah. I wish. If we could solve that problem, our business grows. But yeah, we had a real life example of a husband and wife who built this HVAC company, and they worked 20, 30 years in this, and then they sold it for a couple $1 million, and this is a big life-changing event for them. They built this company up and sold it, and they're like, hey, here's our sales price, here's everything. We were just preparing their tax return. They came to us to prepare this return. And looking at it, I'm like, hey, you're a C corporation. And you've held this for more than 20 years of business. What if I could told you I can get all of this tax exempt from you?
These people are planning on paying 40% tax when they came in.
In their pot, they saved in a savings account like $400,000 to $500,000 for taxes, and they're just like, let us know. And we're like, okay, well, how about you keep the $400,000 to $500,000 you save, because there's ways I can get this whole thing tax free. And they just accidentally structured it right. They had no idea how we did it, but under Section 1202, we were able to get, it was a small qualified business stock. Everything was exempt, and they had no clue they did that. No clue. And we're actually working on a case right now where we know a $10 million, let's hypothetical $10 million sale is going to be coming in the next 5 years. We're structuring this sale in the same way, because he's like, how do I mitigate my taxes? What if we set up a new C corporation, you held it for 5 years and then sold it then? Let's transfer all the assets into the C corp, and now it's all tax free.
Yeah, as beautiful as that story was, where they just happen to accidentally structure it right, 95% of businesses don't structure it right for that.
They have no idea about
But
1202.
95% of businesses could structure it right, but it takes at least 5 years, generally longer, to structure it that way.
And I love that 5-year window, because one of my favorite tools is, if you've got healthy cash flow, you could set up not just a normal 401, actually get a cash balance plan going, shove away 6 figures pre-tax as a business expense every year. You can do that for even husband and wife if needed, and you can pile up a significant chunk of the exit in tax deferred dollars that way. So instead of getting taxed at the 40% or whatever it might be on a giant sum of money, now you're in the driver's seat on the distribution of those funds over time, and they continue to compound while you're not using them.
This is completely off topic from this podcast episode, but you just reminded me. It's 5 or 6 years ago, we were working together on a client. And generally, when people are building their business, they don't have much cash flow.
Of course.
They're using their 401k like I did. I rated my 401k down to 0 to build and establish our firm. And then they're up in their mid-40s and they have no retirement money. And you came in and are like, hey, now that you're making $1 million a year, do you want a nice retirement account? Let's put away $500,000 a year. And we were able to do that and save tons of taxes. And they retired with an $8 million retirement account. And that is cool. That can be done. But sorry, off topic.
No,
Let's get back on to business exits. We're kind of running out of time. How should we land this plan? What would you guys say ought to happen?
I would say in that one case, nobody is going to, I've never been that lucky in my life to accidentally structure it the exact right way.
Yep.
I'm never the guy who's got the lottery ticket. You're not either.
Yes.
So if there's one call to action, it's talk to the tax guys and figure out how you can avoid the massive tax bill that's waiting for you when you sell your business. And secondly, talk to the advising team who can help you get the highest multiple possible.
Yeah. How do they reach out to you? So I would recommend any business owner, because there's always, like we talked about at the beginning, there's always a transition. There's always an exit, whether it's accidental or on purpose. You are exiting your business. The death rate in human history is 100%. Everyone is going to die.
99.9999%.
All of a sudden, it became a religious podcast. What are we doing?
But I also said human.
Okay.
100% human. So
100% human, 100% God. I see you right, Tyler.
that's next episode. But you're going to exit this business. So you need to start today. If you have no plan and you're just flying by the seat of your pants, just trying to grow this business, take some time and focus. Talk to these guys. They know how to get you to where you need to be, and then we partner with you on the tax side. So how do they even get out?
Yeah, easiest way to get a hold of us is bluegrasslegacygroup.com. If that URL's too long, we also have bluegrasslg.com. But that's the easiest way to get a hold of us and have an initial conversation and see where it goes from there.
Absolutely. And I also recommend picking up Kyle's, one of his books at least, the Legends Never Retire,
Legends don't retire, and neither should you.
I recommend that book greatly. It'll make you think about life and retirement differently. As Kevin and I are always saying over and over again, you need a team built around you. The biggest successful multinational corporations out there have a big board of advisors. You need a team that is helping you in areas that you're not brilliant in. And I promise you, you are not brilliant in every area. You might be brilliant in some, but you're not brilliant in every area. Hire that brilliance, find that brilliance, build it around you. Bluegrass Legacy is a great place to start for not just financial planning, but planning for an exit. And obviously us at Revo Taxpayer, we will help make sure you're not paying an extra dollar in tax that you shouldn't have to pay.
I hate leaving tips, even for the IRS.
Me too.